Hello and welcome. Welcome to this amazing series of core concepts through PYQs. We have reached chapter number 9. We have reached monetary policy, and let us see what the question is about. This question came in the year 2021. The question is, in India, the central banks function as the lender of last resort, usually referred to which of the following? So if I talk about RBI's functions, it also includes lender of last resort. But lender of last resort for whom? Whom are we talking about? Let us see that thing. You see this? Banks, they are in a business where they would be regularly in need of money, and they may sometimes also have surplus money. So, what would a bank do if it needs money? In that case, it would borrow from another bank. What if a bank has surplus money? It would try to lend it to another bank. But obviously, suppose if a bank is lending to another bank and then a customer comes and demands money from the bank won't be having money because it has lent to another bank. The bank may think it is an opportunity cost for it if it is lending to another bank. In that case, the bank may think of not lending to another bank, or if it lends to another bank, it will be at a high rate of interest. So, an instrument has to be created by RBI through which, if a bank is in need of money, the RBI is able to lend it money. Alright, and hence comes into picture the two instruments through which the banks can borrow from RBI, and they are repo rate, which comes under LAF, Liquidity Adjustment Facility, and MSF, Marginal Standing Facility. What is repo rate? Under repo rate, a bank will be borrowing from RBI using government securities which are held above SLR quota. The borrowing under repo rate is at the max for 364 days. The borrowing will be up to 364 days, that is, the borrowing will be for less than 1 year, short-term borrowing. But it will be using those government securities which are held above SLR quota. And if it is MSF, here the bank will be even able to borrow from banks. Bank will be able to borrow from RBI using those government securities which are held below SLR quota. That is, for example, the bank had to maintain a 20% SLR. And suppose price of 1 GSEC is 1 rupee. NDT of a bank is 100. In this case, the bank should maintain at least 20 government securities because the bank is having 20% SLR. SLR is 20%, and I am assuming the whole SLR is maintained in government securities. In that case, the bank should maintain 20 government securities, and suppose the bank has 23 government securities. The bank has 3 government securities above the SLR quota. In this case, the bank can borrow using these 3 government securities from RBI using repo rate. But if the 3 above are gone and still the bank needs money, now what? Now where will the bank look up to? It has to maintain SLR quota. In that case, the bank will borrow from RBI under MSF. It will be using even those government securities which are held below the SLR quota. And that is why RBI is called as lender of last resort for the banks. When the banks won't be in a position to borrow from anywhere else, even their SLR quota is done and dusted. It means they have to maintain 20. They're maintaining 20. Now where they look up to? They look up to RBI. So when I say lender of last resort, I am talking only and only about the bank, because the bank, they don't have anything anywhere else to go. And now let's continue the difference between MSF and repo rate. Under MSF, the borrowing is only for overnight purposes, only for 1 day. But if the bank is borrowing from RBI at repo rate, the borrowing can be for 1 day. In that case, it will be called overnight repo. At the same time, the borrowing can be from RBI for more than 1 day, for 7 days, 14 days, 28 days, 91 days. For these many days, at the max 364 days, the bank will be able to borrow from RBI. And under MSF, only and only banks can borrow. NBFCs cannot borrow under MSF. But under repo rate, banks and NBFCs both can borrow. So these are the differences between MSF and repo rate. Now let's move to the question. The question is, central banks function as lender of last resort refers to which of the following? Lending to trade and industry bodies when they fail to borrow from other sources? No. This statement is wrong. So we negate statement number A. Providing liquidity to banks having a temporary crisis? Yes. If they have a temporary crisis, the RBI will be lending them. Statement number 2 is correct. So these two statements are correct. Third one, lending to governments to finance budgetary deficit. RBI cannot lend to government to finance budgetary deficit. It has been stopped in 1997. Since 1997, monetization of deficit has been stopped. Now, instead of monetization of deficit, we have WMAs, ways and means advances. It is sort of a homework for you guys. Go back home and find out what are ways and means advances. And even FRBM Act says that RBI cannot lend to the government for financing its fiscal deficit. There is no direct monetization happening. Third statement is wrong. So when I say lender of last resort, that time I am talking about only providing liquidity to banks having a temporary crisis. Answer is B only. I hope you have understood the concept, which is repo rate, MSF, lender of last resort, all these things, right?